Stop saving money on taxes. That $50 DIY refund? It's actually costing you thousands every year. Here's the wealthy person's math that changes everything. Here is something that will fundamentally rewire how you think about money. When a wealthy person writes a check for $15,000 to their accountant, they are not spending money. They are making an investment with a guaranteed return. But here is what they do not tell you. That return is not just about tax savings. It is about accessing an entirely different financial universe that DIY filers do not even know exists. The wealthy have run a calculation that most people have never considered. They measure every professional expense against a single metric that changes everything. And once you understand this metric, you will never look at professional fees the same way again. We are going to break down the exact formula they use, but first, you need to understand why the conventional wisdom about saving money on taxes is actually a wealth destruction strategy hiding in plain sight. But here is what they do not tell you about those $50 tax software programs. They are designed to get you compliant, not optimized. There is a massive difference. Compliance means you file correctly and avoid penalties. Optimization means you legally minimize what you owe while maximizing what you keep. A study from the National Bureau of Economic Research found that taxpayers using professional preparers claim significantly more deductions than self-filers with identical financial situations. We are talking about an average of $4,200 in additional deductions captured. And this is where it gets interesting. That $50 you saved on software just cost you over $1,000 in additional taxes. Every single year. Compound that over a decade with investment returns, and your $50 savings transformed into roughly $20,000 in lost wealth. The math does not lie. If this is already making you rethink your approach, drop a like so I know to keep going deeper. But here is the thing. The wealthy are not just buying tax preparation. They are buying a completely different relationship with the tax code. Think about that for a second. When you use software, you are answering questions designed for the average person. When wealthy families meet with their accountant, they are having strategic conversations about their specific financial situation. The accountant asks questions the software does not even know to ask. Do you have a side business? Have you considered cost segregation on that rental property? What is your 5-year liquidity plan? These conversations uncover opportunities that boxes on a screen will never reveal. I spoke with a CPA who handles clients ranging from middle-class families to 8-figure earners. She told me something that stuck with me. She said the difference is not intelligence or financial complexity. The difference is that wealthy clients treat her as a strategic partner while everyone else treats tax prep as an annual chore to finish as cheaply as possible. Let me put this in perspective with the actual numbers. The wealthy operate on something called the professional ROI formula. Before hiring any expert, they calculate 3 things. First, what is the potential upside this professional can capture that I cannot capture alone? Second, what is the risk of errors or missed opportunities if I handle this myself? Third, what is the time value of my own hours spent on this task? When you run these numbers on tax preparation, the math becomes undeniable. Let us say your household income is $150,000. A skilled accountant will typically find between 3 and 7% in additional optimization opportunities. That is $4,500 to $10,500 annually. The accountant costs perhaps $2,000. Your return on that professional investment ranges from 125% to 425% every single year. But here is the real opportunity. Those returns compound because the strategies your accountant implements this year continue generating returns for decades. But, everything I just told you? That is just the setup. The real wealth multiplication happens through something accountants call the network effect of professional relationships. Here is how it works. Your accountant does not just save you money on taxes. They become the hub of your entire financial ecosystem. When you need a mortgage, your accountant knows which loan officers understand complex income structures. When you are evaluating a business opportunity, your accountant can model the tax implications before you commit. When estate planning becomes necessary, your accountant coordinates with attorneys to optimize across generations. What nobody expected was this. The wealthy are not paying for tax prep. They are paying for access to an interconnected web of professionals who all speak the same language and optimize toward the same goals. Your wealth. One of my viewers shared that his accountant introduced him to a commercial real estate syndication that his accountant had already vetted for tax efficiency. That single introduction generated more value than 20 years of accounting fees combined. This is the game the wealthy play that DIY filers do not even know exists. The data reveals something shocking about when professional accounting becomes non-negotiable. There is a specific income threshold where DIY tax preparation becomes mathematically irrational. The IRS Taxpayer Advocate Service found that error rates on self-prepared returns increase exponentially once household income exceeds $75,000, or when taxpayers have more than 2 income sources. Above this threshold, the complexity of optimal tax positioning requires professional navigation. But here is where it gets truly interesting. The threshold is not really about income. It is about financial complexity. If you own rental property, have equity compensation, run any side business, or are planning for retirement, you have already crossed the complexity threshold regardless of income. The math does not lie. At this point, doing your own taxes is not frugal. It is leaving money on the table that a professional would capture in their sleep. Yet millions of people who have crossed this threshold continue treating tax prep as a cost to minimize rather than an investment to optimize. And this is how you profit from understanding what the wealthy do instead. The wealthy treat professional fees as a wealth multiplication lever, not an expense to minimize. Here is the exact framework. First, calculate your professional expense ratio. Take the total cost of professional services and divide by the value those professionals capture or protect. For accounting, this ratio should be at least 3-to-1. For every dollar you spend, you should receive at least $3 in savings, opportunities, or protected wealth. Second, build compound professional relationships. Your accountant should know your 5-year goals, not just your last year's receipts. This long-term view unlocks proactive strategies instead of reactive filing. Third, leverage the network. Ask your accountant who else you should be talking to. They know which professionals in their network are worth their fees, and which are not. What the wealthy understand is that cheapest is rarely most economical. The most economical professional is the one who returns the highest multiple on their fee. When you shift from expense mindset to investment mindset, every professional relationship becomes a potential wealth multiplication opportunity. Here is exactly what to do with this information starting this week. If your income exceeds $75,000, or you have financial complexity, interview 3 CPAs. Yes, 3. Ask each one what opportunities they see in a preliminary review of your situation. The best accountants will identify potential savings before you sign anything. Compare their insights. The accountant who sees the most opportunity and can explain why is worth their premium fee. If you are below the threshold, use this year to document your financial life properly. Track every potential deduction, every side income stream, every financial decision. This positions you to maximize value when you do cross the threshold. Remember, the wealthy did not start with expensive accountants. They started with the mindset that professional expertise is an investment with measurable returns. That mindset shift is available to you right now, regardless of your current income. The question is not whether you can afford a professional. The question is whether you can afford to keep leaving money on the table year after year. Now you understand the math that wealthy families have used for generations. Professional fees are not expenses. They are investments with measurable, compounding returns. Subscribe to decode more financial truths the banks will not tell you. We are the only channel that challenges conventional wisdom with data. Tell me in the comments, are you making the $50 mistake, or ready to think like the wealthy? Drop your situation below. I read every single one.